We're just at the beginning of either a revaluation of gold or a potential accumulation of gold across central banks. Then obviously you want to play the scenario of the supply, which supply for gold is a much easier, although there are moments where you see lots of discoveries and supply changes, but the visibility of supply for gold is very clear. Now, there are no major new discoveries that will probably change the supply curve drastically. And we don't know of any major production or list of mines going into production that will also change the supply curve dramatically. And so the visibility for the next 5 to 7 years at least, or even 10, is very clear. And so I don't think we are in a bear market for gold here.
Navigating financial market volatility requires focusing on long-term supply and demand fundamentals rather than reacting to temporary price dips. Macroeconomic shifts indicate that recent pullbacks in precious metals present prime buying opportunities for savvy investors. Tavi Costa, a leading portfolio manager and global macro strategist, highlights that central bank gold accumulation is only in its early stages. With U.S. gold reserves currently backing just 3% of Treasuries compared to 50% in the 1940s, monetary authorities face structural pressures to rebuild physical reserves. Furthermore, with no major gold mine discoveries slated for the next decade, supply visibility remains exceptionally tight. Costa predicts a 70 to 80% probability that recent price declines mark a bottoming process within a secular bull market rather than a bear trend. He anticipates that impending policy interventions will inevitably unleash a massive rally across hard assets, propelling physical gold and mining equities to new highs. Investors expanding positions during market stress stand to capture maximum long-term upside. Now, we present the clips from Tavi Costa's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I think in periods like this, you have to try to reassess your views when you have a sell-off like we saw recently. And you either are initiating a bear market or you're seeing a pullback that is a major opportunity. Every investor will deal with that question every time there's a decline of the asset they're investing. So let's play the scenarios. What would make gold not be in a bull market today? What would make gold perhaps be initiating a bear market? Well, we have to think from a structural aspect of supply and demand. Demand is mostly coming for the metal from central banks. Have certain central banks already accumulated enough gold that they will probably stop purchasing gold over the next 5 to 10 years? Well, I can answer that question with a lot of confidence, especially in the US alone. If we just take the US, about 3% of all overall US Treasuries are backed by gold today. Back in in the 1940s, it was close to 50%. So, we're so far away from seeing enough gold reserves restore credibility for the Treasury market that I think that, we're just at the beginning of either a revaluation of gold or a potential accumulation of gold across central banks. Then obviously you want to play the scenario of the supply, which supply for gold is a much easier, although there are moments where you see lots of discoveries and supply changes, but the visibility of supply for gold is very clear. Now, there are no major new discoveries that will probably change the supply curve drastically. And we don't know of any major production or list of mines going into production that will also change the supply curve dramatically. And so the visibility for the next 5 to 7 years at least, or even 10, is very clear. And so I don't think we are in a bear market for gold here. So that leads you to the conclusion that, okay, then that's very likely a pullback. Let's put a probability here. Let's say it's well above 50, maybe closer to 70 or 80% chance that this is a pullback. Okay. How many pullbacks we tend to see in history during secular bull markets? Is 28, 30% decline normal? Do we see things even steeper? And what you're going to learn is that it's very unusual to see this degree of a decline, and usually tends to be a very important opportunity. Can that volatility stay in place for 2 years or a year or something along those lines within a decade long of a cycle, sure, that's a possibility. But your window of opportunity of buying the metal here on what appears to be the beginning of a bull market, or I should say the process, the bottoming process of within a bull market, I think it's much more likely than the other way around. So you never have certainty on any decision you make in markets, in life. It's impossible. And if that's you, you will always be behind the curve because you're always waiting for confirmation to act. And if you're waiting for confirmation to act, you're never getting the best price, or you're never getting the best deal. And it is what it is. And maybe if that's you, then you take that approach. That's not me. I think that the wealthiest investors and most successful investors that have made their wealth in history were people that were comfortable, adding to their investments and their positions and in moments of stress and being right about that. And so if I have all this sort of scenario played out, and I think that this is a good moment to be acting, I'm going to do that. And so I am very concentrated right now. Do I care of the volatility on a daily basis? It doesn't bother me. I can sleep at night. But some people get bothered by that. If we have another month of down performance, some people freak out on this. And it's not the way my brain works. I'm comfortable with the thesis. I know, that the risk that I'm taking, I'm not over my skis. I'm not asking for my in-laws capital to buy gold or anything along those lines. I'm acting, very rational here. And just trying to add to my positions gradually as we see volatility play out. And I'm never, fully invested because I never know the future. And luckily in my life, and maybe that's the case with others, I still receive cash flows. It's not like this is the end of my life. I'm not just acting with all the money I've already made. No, I still get cash flows. As I get cash flows, I think about things. All right, what's cheap here? And every month is a new month to think about where to allocate capital.
Secular gold bull markets frequently experience steep pullbacks of 28 to 30%, creating essential entry points for disciplined capital allocators. Right now, senior gold and silver mining companies trade at deep cyclical discounts of 40 to 60% from their peak levels, despite gold prices remaining strong. Supply constraints further reinforce this bullish thesis, as no major mine discoveries exist to alter the production curve over the next 5 to 10 years. Holding excess fiat cash in this macro environment creates significant opportunity costs, especially as inflation weakens purchasing power. When inevitable economic pressures trigger central bank intervention, hard assets will lead the broader market recovery. Adding exposure to oversold precious metals during periods of market volatility positions portfolios for substantial outperformance before wider market confirmation drives prices higher. Now, let's get back to the interview.
The beauty of the market today is that you have a lot of the consistent cash flowing seniors trading 40, 50, 60% from peak levels. And you don't get the chance to buy some of these seniors at these sort of steep discounts very often, with gold prices still above $4,000 an ounce. So I think it's very prudent to be owning some of them. When I think of my more macro portfolio, so I have a more liquid portfolio, and then I have more illiquid portfolio, if you will, where I tend to be more specific and unique on ideas, miners that are in specific unique situations or whatever the case is that I thought was important and attractive to invest in those companies. And then I have another part of my portfolio that's more liquid. And that liquid portfolio, I probably have never been so concentrated on the gold seniors and copper seniors because and silver as well, because it's they're really cheap right now. And so I think I barely own any. Well, there are moments where I own gold. There was a moment more recently here where I thought that gold was going to maybe bounce a little first than to the miners, and I decided to gradually move my cash balance into gold balance, basically, right? Like, why hold cash if I could hold gold at oversold levels? And I would argue that very much so with most companies that have a treasury of cash these days. You're not going to see a lot of times in history where where gold is going to be as oversold as it is if we are right about the cycle, especially if you're a gold miner, where I think that fundamentally a gold mining company would agree with the view that gold prices should be going higher, not lower. Otherwise, what are we doing here? Uh, but I, understanding that there are risks involved with, being a mining company and owning gold in your treasury, but I think there are times when you should do that. I think the timing today is very attractive. I don't see a lot of reasons to own cash right now, in my opinion. I think there's a podcast that somebody put out of me saying that we don't own it. Like that was put out of context, very much out of context, because I was saying that if yields keep going higher, we would see, something very, very severe in the economy would likely collapse. I don't think that's going to happen. Otherwise, I would be full in cash right now, and that's not my view. I think what we'll see is some level of intervention. And as we see intervention coming in, I think you're going to see an unleashing of hard assets, and gold is going to lead the pack, and miners are going to benefit. And so that's why I'm with that view. But I'm also mindful of companies I own that are they also have a cash balance that need to be managed. And in some cases, some of these mining companies have never had such a large cash balance in their history. And it is, to me, very critical how they choose to invest that cash, because in the world that we are today, with gold as undervalued as it is, relative or oversold as it is in the near term, to me it's very plausible to own some of it.
Successful long-term investing depends on maintaining deep conviction during market downturns rather than waiting for price confirmation that forfeits favorable valuations. Building wealth requires comfortably expanding allocations to high-conviction assets when market sentiment reaches extreme stress. Modern macroeconomic conditions make holding large fiat cash reserves increasingly impractical, particularly when top-tier mining companies possess exceptionally undervalued balance sheets. Dividing capital between liquid core holdings and specialized mining equities allows investors to manage short-term volatility while capitalizing on specific growth setups. Corporate treasuries that strategically convert cash reserves into physical gold gain an advantage, aligning directly with long-term commodity upside. Daily price swings should not disturb a well-structured thesis, especially when structural supply limitations ensure clear market visibility for the next 7 to 10 years. As mounting debt liabilities force monetary intervention, physical metal revaluations will accelerate, driving cash-flowing miners into an explosive expansionary phase. Operating with strategic patience during oversold setups ensures maximum upside when tangible assets regain momentum. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.